Banking Book Analytics Webinar Series 1, Episode 3, Enhancing Profitability at Credit Unions, Alignment of Strategy with Capital, presented by BBA.
Hello, everyone. Welcome to Banking Book Analytics Webinar Series. This series is focused on credit unions. This webinar, Enhancing Profitability at CUs, Alignment Strategy with Capital, with Suhail Farooq, the founder and CEO of Banking Book Analytics, and Andy Popawa, our advisor with extensive experience in this sector. My name is Paula Saad. I am Chief Commercial Officer at BBA, responsible for business development and customer experience. I will be moderating this today's session. We will move to some housekeeping notes. Suhail, if you can move to the third slide with the housekeeping notes. Thank you. Just make sure you guys know that the session is being recorded and it will be available in our YouTube channel. Please also read the disclaimer on the screen in terms of accuracy of information provided and copyrights. In terms of questions, we'll be taking questions through the session actually, but also if you have any questions that can wait for the end, you can do it via chat or directly to the panelists when there is an opportunity there. Suhail, I would like to invite you and Andy for a briefing before we start. Actually, Andy, can you go first and then?
Sure. Let me get my picture up here. Good afternoon, everyone, and welcome and joining us for this webinar, this third of in one of our series this year. Today, we're going to be a little focusing on a little bit on how you can enhance profitability. I think part of the challenge going forward is all the things that are changing around us, which we'll talk about, I think, in some depth. So my name is Andy Popawa. I'm a former CEO of the Deposit Insurance Corporation of Ontario, the regulator for credit unions in Ontario, as well as a corporate director on a number of different corporate boards these days. Have a long experience and history in the financial services industry, and I'm very happy to be here with you today. Thank you.
Thank you. Suhail, can you give us a little bit of background on yourself and also BBA?
Yes, certainly. Thank you so much, Paula, and thanks, Andy, for the introduction. It's great to be here. Good afternoon, everyone. My name is Suhail Farooq. I started BBA after working at Moody's, seeing how expensive, how inflexible the software products were. I started the company to really disrupt the $85 billion financial services application software industry. Development and deployment of on-premise software still dominates the market and continues to jack the prices up. For small to mid-sized financial institutions, financial software products are not just unaffordable, they lack customization, and the way the fee are taken away, that is not transparent and take the control away from clients. The great thing is, because of growth in cloud distributed technology and agile software development, you can really give the control back to clients in a much more affordable and transparent way. We focus on developing the products that is very much scalable, and we are really excited to take it into the backyard of our competitors. Because we believe when you put the customer first and the product first, that's how the opportunity to really transform and bridge the technology gap occurs. Our goal, our mission, our vision as a company is to help small to mid-sized financial institutions get the control and return on investment back in a fundamentally better and more convenient way. And that's what motivates me every day. We have really got a great underserved market, an opportunity to create a huge amount of value. So our job is really to make sure that our customers get the products that we promised, and they can actually deliver on our promises, and that we can deliver on our promises, and we're just getting started. Thank you, Paula.
Thank you very much, Suhail. Andy, I guess we're going to start the main part of our webinar today. So please go ahead.
Perfect. Well, thank you so much, Paula. Happy to briefly, really briefly introduce what we do. As Andy mentioned in the beginning, this is the third webinar of our Series 1. And the focus has really been on helping credit unions or mid-sized financial institutions understand the challenges that they face within the context of COVID-19 and how they can transform themselves. Some of the products that we have created really address bridging that gap. They also understand the challenges that the clients face, and therefore we would like to actually briefly describe what they're capable of doing. I'll just start with the main products, or what we would call the flagship solutions. The first and foremost is Scenario Frontier. Scenario Frontier is a powerful tool that combines 4 different softwares currently being offered in the marketplace. It combines transfer pricing, ALM solution, with risk quantification that would include credit, market risk, and so forth, and macroeconomic scenario modeling, and finally, the budgeting and forecasting. So from a small to medium-sized financial institutions, it would make sense to actually get one software that is capable of doing things that 4 softwares would purport to do. The second flagship is really around what the ECAP Leader, which is our flagship ERM solution. It is not just ERM, but it also combines the risk quantification in terms of a steady state capital management within the organization. So that's sort of briefly kind of, I hope it spikes up your interest. I would invite you to visit the website to learn more about our other solutions. Not just that, we also have an advisory piece. As Andy mentioned at the beginning, Andy brings a rich, versatile experience, both from regulatory and business perspectives. And similarly, my domain expertise resides in treasury, finance, and risk. So together, Andy and I and the rest of the team, we provide solutions, we provide advisory within the regulatory compliance, non-financial and financial risk management, and profitability and pricing analysis. So that brings us to the main body of the presentation. So the focus and the format of this discussion is really based on Q&A. We're really fortunate to have Andy with us today. So I'm just gonna sort of, throw a lot of balls at you, Andy, and see if you are able to share the rich experience that you have. So let's just start with how the design and development of strategy is disrupted before and after COVID-19. Andy, your thoughts?
Thanks, Sohail. A special shout out to my colleagues that I've known for many years in the credit system that are on the call today. So happy to see everybody here. So those of you who have been in the credit system and indeed in small financial services companies or organizations will know that even before this COVID situation started up and occurred over the last number of months, there was already a number of disruptors sort of moving the whole sector in a different direction. And part of that is really based on a number of things. And as this slide indicates, there's a few things to think about. On the left-hand side of the slide, you see that there's impact on the pillars of business. And traditionally, as we all know, financial services companies have been sort of focused on sort of 3 major areas. One, obviously, was credit, providing credit, especially those deposit-taking institutions to their members and customers. Second one is wealth management of some sort, whether it be at the retail level, wholesale level, or managing major chunks of the funds of those pension funds and others. And finally, the third chunk speaks to the issue around other financial services associated with what those organizations do. And of course, each one of these, given the current circumstances, both in terms of disruption before and after the COVID situation, have been impacted by the various components of those disruptors, and obviously technology is being one of them. So that that starts speaking to the impact on the business models, which is on the far right-hand side of the slide. Traditionally, all these institutions used to live on financial margin, and as that got slimmer and slimmer, they started looking at other forms of revenue, whether they be revenue from financial services associated with banking and other organizational activities, or something else that could generate some form of revenue or income. And now what we're seeing is more of a multi-channel, a multi-product business model. So institutions that are broadening their horizons, diversifying in many different ways into the marketplace. And they're starting to look at that from a completely different perspective, given the technologies that are out there. And so the last part of the puzzle is really, so what's that mean for, the members, in the case of credit unions, owners, and other stakeholders? How does this all factor in? Well, one of the biggest concerns, of course, for most institutions are, and that's why they survey us all the time, is what do we actually want? What do members and customers of credit unions really want today? And what do they really need? And how do we satisfy those needs and wants? And that's all those three sort of different focuses are now moving towards credit unions and others, looking at their business models and their strategies and sort of playing out a long-term strategy on what's going to make them sustainable. And so if we could go to the next slide. Thank you. So this really starts talking about the strategic aspect of it. And those of you who are in management and on the boards of credit unions will see this sort of, this looks familiar to you. The first part of course, is making the decision to refresh strategy, looking at what's going on around us and how this all comes together. The first part of that whole process is really making sure that the core capacity of the credit union and the organization is there. And that means looking at the investments in technology, in particular banking systems, for example. What kind of investment has the credit union made in its people over the last number of years, and what kind of investments are going to be required in the future? And what kind of process and controls have been put in place to make sure that the organization is not only following in compliance with regulatory requirements, but also sound business practices. And then from there, you move on to how do we protect the revenue base? Where is our current revenue coming from? How can we enhance that? And what other new opportunities are there in the marketplace? And this is where a lot of credit unions tend to struggle, because things like service fees and other fees are almost contrary to the cooperative sector philosophy. And so we move into this area with delicacy and concern, because there's always this tension between members and shareholders and the credit union itself. The next step, and most credit unions have gone through this, the most obvious one is to cut costs wherever possible. Very good short-term solution to the problem of enhancing profitability and ultimately capital. But it's only a quick win and only lasts for so long. You can only cut so much. And of course, credit unions in Canada in particular, being smaller players, have got this huge disadvantage against the larger players who have scale and scope. And finally, the place that we all arrive to at the end of the day for more complex institutions is looking at managing the balance sheet, looking at a strategy that's going to manage that balance sheet to finding the optimum asset liability mix to build long-term sustainability and ultimately capital, which will support the organization going forward. So that's a really brief tour of where I think things are at today. That's going to evolve, obviously, but those are the key components. And maybe I'll pass it over back to you, Sohail, or if there's any questions, happy to address them. Thank you.
Exactly. Thank you so much, Andy, for sharing your rich experience. And I personally think that this is a watershed moment for a lot of cooperatives and a lot of community-based financial institutions. And one of the key things that I took away from your conversation was understanding and defining who your relationships are. And within that spectrum, we look at regulators being, of course, one key driver of the capital regulations and so forth. But the most important relationship that credit unions have is with their members. And really, we need to be able to understand that from a member's or from an owner's perspective, what is it that the credit unions can do different and how they can refresh the strategy in a post-COVID-19 age. So this is really the focus of our discussion as we move through the rest of the webinar. And if you were to actually just distill it in two basic principles, what is it that we're trying to accomplish? Keeping everything else equal, such as, the current operating system, the current core banking system, the current sort of infrastructure and cost. The members are looking at how they can enhance the earnings that they derive from credit unions. And really, that's what the focus is, or focus should be on a go forward basis. So in order for credit unions to actually determine what are the challenges that are out there, the key thing that they need to take away from this watershed moment is the acquisition of low risk weighted assets. And quite frankly, they have been very good at doing it, and they have been doing it for far too long. But what is missing from the second side of the equation is really developing an understanding of the capital contribution from each transaction. So in other words, are the transactions that the credit union's making, assets that they're acquiring, creating the value, accreting the capital, or depleting the capital? Now, that's really an important aspect of the equation that we need to understand. So just to sort of deep dive a little bit on the principle one that we talked about in terms of acquiring the low risk weighted assets. As we all know that DICO and FISRA have different assignments in terms of the risk weighted assets. The risk weighted assets, the risk weighting ranges from 20% to something like 150%. To give you an example, a residential mortgage is assigned a risk weighting of about 50%. A commercial loan or a commercial mortgage is assigned about 100%. So clearly, once they have higher risk weighting, that means that this is systemically an arbitrage opportunity sits in the system that needs to be exploited more and more. So residential mortgages or retail lending is really the key focus as we kind of move along through the sort of recovery phase of COVID. Now, if you were to look at the impact of these sort of risk charges or risk weights, as you can see that, we've sort of drawn up a little formal example here, that if we were to actually borrow money from a personal loans perspective, it's assigned 80% risk weight. But if you were to actually lend it from the residential mortgages perspective, it is assigned 50%. So that implies that, clearly you have relatively lower exposure, and with the same level of pricing, you're going to actually enhance or create more capital for your transaction if you were to actually acquire more and more residential mortgages. Now, within the real estate market, there's talk of disruption, there's talk of a bubble. So, of course, there is an important risk aversion that we need to keep in mind, but that is really not the focus of our today's conversation. So we want to actually jump into the second side of the second principle in terms of understanding how it is being played out in the industry. So here we have some empirical evidence within the Canadian financial spectrum, and doesn't, of course, include credit unions, but all publicly traded financial institutions. So if you were to actually divide the entire spectrum of financial institutions in two different zones, the zone one being a capital creation zone and zone two being a capital consumption zone, then we would notice that most of the big five banks, or almost all big five banks, are actually in a capital creation zone, except for Scotiabank, which is not being presented here because we weren't able to get the right data for that. But if you can see that RBC leads the pack, followed by TD, and then we've got National and CIBC. They're all in capital creation zone. But if you were to actually look at the remaining financial institutions, you would notice that some of the smaller one and relatively mid-sized one are either on the boundary or on the cusp of capital creation, or they're actually primarily in a capital consumption zone. That essentially implies that every transaction that they make is being subsidized or is not really providing the capital that they need. So, for example, we're looking at VersaBank, Laurentian, and CWB. They're either at the cusp or they're either in capital consumption zone. So that's really the net result of creating a balance sheet that Andy referred to, which is not defensive, and especially in a situation or in a period like this, if you have a non-defensive balance sheet, you would be actually more exposed to a capital consumption side of it as opposed to the capital creation.
So Sohail, just if it's Andy here, if I just jump in on that point though. So a lot of those banks that you're looking on the left-hand side of the table there, except for I guess Laurentian, are relatively speaking newer banks or smaller banks, and to just to equate this to credit unions who have been around, a lot longer than these banks. If you had to guess, where do you think the credit unions are in this capital consumption zone versus the capital creation zone?
That's a very interesting question, Andy. I mean, in order for us to, of course, answer this question, we need quite a significant chunk of data. But that being said, one of the key things that, in our analysis that we have come across in terms of analyzing the data is the efficiency ratio of credit unions. And of course, that plays an important part in terms of understanding and in terms of pinning it down, whether it's in consumption or capital creation zone. And as you know, as we all do know, that the efficiency ratio on a relative basis at credit union is much lower. In other words, we are looking at an efficiency ratio of roughly 60 to 70%. And you compare that with banks and other financial institutions, which are operating either in mid 50s or early 60s. So all things being equal, I would still consider that credit unions are perhaps somewhere at the cusp or at the boundary of between consumption and creation zones.
Yeah, I think that's right. I think a lot of credit unions are still consuming a lot of capital because they're growing at a fairly high rate of growth on the asset side. So I think that's a fair comment. Thank you.
Perfect. So so we talked a little bit about within the credit union system, there are inherent challenges. The first and foremost challenge is that they're required to operate in a very specific jurisdiction that can inadvertently lead to higher concentration risk. And of course, the second challenge is if you were to look at the entire suite of products that the credit unions offer, and you talked about the concept of diversification. And we're seeing a lot of credit unions now setting up their internal investment portfolios, to be able to diversify into different areas. But that being said, Andy, do you see that there are some white spaces for credit unions that they can acquire, in sort of this watershed or refresh strategy phase of COVID-19?
Well, I think one of the key things to remember about credit unions is that they are largely and always have been community-based organizations that stand by their members and their communities when things get tough. And so I think this COVID situation is actually a great example of when credit unions can come to the table and help their members when others don't. So, in the past, we've had situations where credit unions members who are on strike have been provided, some kind of deferral of payments when there's other kinds of labor strife, when there's other kinds of natural disasters. Credit unions are typically more likely to provide relief to the members, especially on the credit side, than others. So I think part of the answer to your question is that credit unions, by their very nature and their philosophy, are there to help their members through those tough times. So I think that's going to create opportunities in this kind of environment. That's on the credit side, and the other side as well. They're also supportive because they are in the community that they serve. They are part of the fabric of the community, which again helps them get participation in things like volunteer events and so on. So I think that's a huge advantage, and I know banks are trying to do that too, on a different scale, perhaps in a different way. But I do think that credit unions and the communities that they serve play a very important part and are an important part of the social fabric.
Exactly. Exactly. So, so in terms of some product white spaces, credit unions, of course, are very active within the retail segment. We talked about the community that they're supporting. We talked about the commercial side of the portfolios that credit unions have. Of course, in a in a scale of 1 to 10, on a scale of 1 to 10, the real estate exposure ranks really, really high. But are there any opportunities for credit unions to engage themselves in, let's say, trade finance, or focus more on small business or SME lending as opposed to the commercial real estate? Because SME lending and trade finance both have relatively lower risk weights.
Well, I think I think they're already there. I think some of the colleagues on the call on the webinar today would verify that through their own their own operations. I think that the issue there is two things. First of all, scale. While a lot of credit unions are in the SME credit business, scale-wise, they're smaller players in the marketplace, and therefore can only attract so much. And then the other limitation, of course, is capital. Every time you make a commercial loan of whatever type, it's going to eat into the capital level. So that's another constraint has been going on for quite some time. But I do think that again, as more and more credit unions start broadening their horizons with respect to what their product base is, the multi-channel, multi-product strategy that they're thinking about, I think there's going to be further opportunities to grow the business.
Exactly. So yeah, with that, I would draw the attention of the participants to this particular slide, which really lays out, how we can view different portfolios and their contribution with regards to the capital. So the size of the bubble represents the book capital, or in other words, the equity. So and of course, we've sort of, on the vertical axis we have the value add, and on the horizontal axis we have the capital generation capability. So SME or small business lending continues to rank as a capital generator, and if you were to actually draw a 45-degree line right from the intersection of the two axes, you would see that SME really sits right on the efficient frontier from that perspective. And of course, high net worth individuals and wealth management business also has relatively lower capital consumption, but adds significant value. So, from a leveraging perspective, that looks like a great opportunity. And we have some great success stories associated with developing or transforming credit union business to high net worth individuals, Blue Shore Credit Union being one of those success stories. And as Andy mentioned, that, always looking for some white spaces and be able to tap into the opportunity where you don't see that some of the big banks are involved in, and be able to capitalize that. Okay, so I briefly mentioned subsidy and efficient frontier. And this is really a little bit of deep dive into those two concepts, So if you were to actually look at your entire loan book, and what we are trying to determine is that how many of the members are subsidizing the good sort of credit is subsidizing the bad credit. So what is the definition of good credit from a credit union perspective? So good credit is, of course, that is accreting capital. In other words, has higher returns, which could be transformed into retained earnings, and then could be contributed into capital as a pure form of capital, increase your tier 1 capital base. And then, of course, what would be a bad credit is essentially those relationships or those lending transactions where a credit union is typically underpricing or subsidizing the members' borrowing. So these are really two important concepts for us to understand and be able to kind of glance over our portfolios and determine whether or not this relationship is sustainable or it is unsustainable. Now, if you were to add an added dimension of COVID-19 or being able to stand next to the community in tough times, how that constraint would play out. Andy, what are your thoughts on that? Are credit unions able to exit the relationships in times like this, even though the members or which are good credits are subsidizing the bad credit?
Well, so this is a complicated, question for credit unions whose philosophy has always been, a member is a member is a member, and the whole concept of pricing for risk was always been a bit of a challenge. I think, though, it's fair to say that a lot of credit unions have moved past that now and do look at risk as a major component of the pricing of the credit. And so, therefore, I think this is becoming a bigger issue of being able to get the data and the information to make this this kind of modeling possible. And as we know from our experience with a few credit unions that we worked with, once you get that data in front of management, it makes it's sort of almost like an aha moment. We now see that management says, wow, we didn't realize that there was so many, a large number of credits that were being subsidized by other credits on the books. And so this starts fine-tuning this whole concept of pricing for risk. And
exactly.
Once that happens, then I think that the strategy of the organization starts changing. The question then becomes, how do you manage the fallout, the relationship between those members that are higher risk, perhaps, than others? And that's part of the challenge for management to go through forward. But at least this gives you an idea, tells you where you are on that scale and how it looks. And of course, back to the question of data that you've talked about already, part of the challenge, of course, is getting the right data out of the systems that the credit unions use.
Exactly. So essentially what we are trying to do here is we are trying to determine what kind of metric be developed with regards to understanding that how subsidies are affecting the good credit from the bad credit, and playing themselves out in terms of dumbing down the profit, and as a result, eating away the capital that credit unions have, and of course, capital is a very, very precious commodity. So if you were to actually draw a line and see, what is it that we want to accomplish? So we essentially want to develop what is known as an efficient frontier, which sits on the standardized market line, or what we would call a hurdle rate line. Now, we will talk a little bit about two important concepts, in a bit. The first important concept is the hurdle rate. And the second is really on risk-based pricing that Andy mentioned and touched upon. And they're both very interconnected with each other, because once we know what the hurdle rate requirement is, we are able to then determine whether or not a single member's credit is being either subsidized, or is it under the hurdle rate, or is it above the hurdle rate? So that's really the important concept that needs to actually bring itself forward for us to sort of then segregate the good credits from the bad credit. So if you were to extrapolate and project it further, what we are trying to say is that if different portfolios are either creating values or they're destroying the value. So for example, as I said earlier, the important part is the understanding of the hurdle rate. So what is the minimum acceptable rate from a member's perspective that would add to capital? And with new regulations that have come out, it is now becoming more and more possible to determine such data analytics, IFRS 9 being one of them. Of course, the key objective of IFRS 9 is for us to determine the expected credit losses, but really that is the input from a risk-based pricing perspective. If we can understand that what is the portfolio's expected credit loss, we can then start putting together the other building blocks to have the entire pricing perspective based on risk-adjusted return on capital. So doing a little bit of deep dive, we mentioned the word hurdle rate. So a hurdle rate typically is determined using the famous capital asset pricing model, which is, of course, it sounds very complex, but it's very simple to calculate. Essentially, it is really to what extent the return is in excess of risk-free rate and a benchmark return from an industry or market perspective. Now, if you were to think of risk-free rate, at least on an annualized basis, that is really Bank of Canada's Treasuries rate, and the rates being really, really low, so we can consider that as something around the 3 to 5 basis points or to that level. And then what is the benchmark return that individuals can have? And this is the concept of an opportunity cost. So in other words, for a member to really put the money in a credit union, what are the other alternative options or other alternatives available to members that where they can park their deposits? So that's really the benchmark question that members must be grappling with when they're parking their deposits in credit unions. Either it could be stock market, or it could be some other sort of investment vehicle, or the credit union itself. So to lure that sort of deposit into a credit union system, some return needs to be offered. And of course, it may have some other intangibles such as security, safety, deposit being insured, and things like that. So of course, there is an offsetting aspect to it, but if you were to actually compare that offsetting effect and take that out of the equation, we are looking at an average cost, presumably around 6%. Which could be considered as a cost of equity or cost of raising the capital or a marginal capital. With that knowledge with us, now we can determine what is known as risk-adjusted return on assets. So, that requires a weighted average. So we worked that example out, and we're looking at about 1.5 to 1.6% as the return on risk-adjusted return on assets. So for any incremental asset, all things being equal, at least this sort of benchmark needs to be addressed. But when we look at some of the other elements, we start building up the price that we talked about, which is around 1.6%, which should be deducted from the funds, which should be deducted from the interest income. And then the important aspect is the expected credit loss. And think of expected credit loss as an insurance premium that you really need to have. So once you deduct that from the net non-interest or from the interest income, and then the operating expenses to mobilize the relationship, to market the products and so forth, that would allow you to come at a level where you can determine what is the risk-adjusted profit from each transaction's perspective. And if you divide that by economic capital or your capital position based on DICO's calculation requirement, you can determine what is a risk-adjusted return on capital. And that's really the number that you need to have against each and every borrowing member so that you're able to understand whether or not they're above a hurdle rate or below the hurdle rate and hence are contributing to capital or are actually consuming the capital. And does it make sense?
Yeah, so I was just going to add one more comment to your analysis on RAROC and economic capital, and that is that a lot of credit unions, the ones that are doing this, are doing it on a portfolio basis. Perhaps you could just comment a little bit about the benefits of doing it on a portfolio basis.
So exactly, thank you so much, Andy. So I think portfolio basis view is considered as a top-down view. It's important to do it at a top-down level, and that's a great way to start, as opposed to really going into the bottom up, which is really where we are looking at each and every transaction and identifying the return attributed to each transaction. So if you were to think of it at a portfolio level, it's even easier to do, because we now have all these input requirements from data perspective that we can use, and we can quickly come up with a calculation at a portfolio level, and which makes the calculations quite simple. And now what we have is an apples to apples comparison across different portfolios. So, we can look around different portfolios such as automotive lending, commercial real estate, small business, mortgage origination, and so forth, to be able to come up with that level of granular or top-down pricing. Okay, perfect. So moving on, I think we talked a little bit about top-down, but from a bottom-up perspective, we have two important elements that we need to keep in mind. The one is activity-based pricing, or if you were to actually create a formal framework, you need to be able to understand how the prospects identified, how the prospects become part of a credit funnel. And once they're part of the credit funnel, how long does it take to be able to actually go from a credit application all the way to the commitment letter? And and from that perspective, that cost associated with the activity needs to be brought into that the equations that we just discussed. You have that, and then some of the other key elements are understanding the expected credit loss that we talked about. Now, of course, some credit unions do have risk rating or rating grades assignment in place. They use templatized version, which are usually developed based on expert judgment. Some do have developed models, which are developed using quantitative and qualitative factors. These factors could include various sort of range of default predictiveness. So they are used to determine the risk rating, especially on non-retail side. For the retail side, of course, you can make use of beacon scores, and you can also make use of TransUnion or other credit bureau related data. But the key here is that how do you map it with the default rate or the probability of default? Again, not very hard. We can do it quite quickly. It's very simple calculation, given that now credit unions are all in the expected credit loss or IFRS 9 regime. That's a possibility to do that. And hence, you can develop what is known as a bottom-up approach to develop the risk-adjusted return on capital. Now, I think we come back to the real world where we have data available. Now, and Andy pointed that out, where do the credit unions sit relative to capital creation versus capital consumption zone? Let's look at the big banks here in Canada. Now, unfortunately, we now have Scotiabank's data available. If you look at the risk-adjusted return that the big banks are pursuing, they're hitting a target which is around 18% on a risk-adjusted basis for each transaction. And we also looked at those financial institutions which are consuming the capital. We're looking at a risk-adjusted return of about 10%. So 8 percentage point above those financial institutions which are at the capital consumption zone. Clearly, the return at 9.6% on a risk-adjusted basis seems reasonably high, but yet they're consuming the capital. On the flip side of it, those that are creating capital based on the returns and pure form of retained earnings are, of course, 8 percentage point ahead of them. So that's, again, an empirical evidence that shows us that not just having mere return would address that challenge, but you need to be able to actually have a return which is somewhere in your mid to high teens to be able to maintain that capital creative zone within the institution. Andy, would you like? Yeah.
Just if I could just comment on that. Clearly, one of the big differences between financial institutions like banks and credit unions is that the banks have to produce a dividend, so therefore they have to produce a fairly significant margin and a return on their assets. Credit unions will argue that their return to their members is through better services and better pricing at the retail level in particular, and maybe at the wholesale level and commercial level as well. So it's sort of comparing a little bit of apples to oranges at times, and that's something that credit unions need to keep in mind. Thanks.
Absolutely. But we definitely make certain that those are some of the things that credit unions have in terms of the advantages compared to the banks. Indeed. But that being said, they're of course apples to oranges. But within the credit union system itself, Andy, are you noticing that there is more and more investments which is coming from the investor community in credit unions and to beef up the tier 1 or to actually add additional tier 2 capital?
Absolutely. Most large credit unions today have got investment shares issued to their members, which typically would attract dividends and therefore require return. So yeah, absolutely.
Okay, great. Perfect. So as we said earlier, these are important concepts, and they do create linkages with the members, with the stakeholders. And by stakeholders, we mean regulators and the investors, and of course the members as well, and more so with the management, within the management too. So creating that level playing field and having a comparison on an apples to apples basis, not just within the credit union system, but outside the credit union system is going to allow a level of transparency which probably was not in existence there. And of course, having the capital efficiency in place is going to give additional confidence to the members, and having them develop the understanding of hurdle rate and how every transaction is analyzed so that it is above the hurdle rate will also provide additional confidence to members. So some of the credit unions need to be able to understand and develop a risk appetite framework, which would not just include sort of course, member-related statements in terms of the member satisfaction, in terms of the service delivery, turnaround times, and so forth, but also have these key quantitative metrics in place so that members are able to understand that, you know, the institution that they stand behind is also delivering and protecting the capital. Andy, your thoughts on that?
Sorry, I keep forgetting to turn off the mute button. No, you've got it right on. You know, I think part of the issue around capital adequacy, as you've got in the slide here, is really making sure that capital efficiency is part of the discussion. And a lot of credit unions have raised a lot of money, but then they go off and they continue doing the same, having the same strategy with respect to capital management that they had before, without thinking about the fact that this new capital costs a whole lot more money than the previous capital, which is retained earnings or membership shares. So I think that's a very important element in the conversation around how do you strategize to make best use of your capital.
Exactly. Perfect. So if you were to actually sort of you know, determine the benefits of and compare it with the current situation to a situation that can potentially emerge after COVID-19, the traditional performance is really focused on asset acquisition, notwithstanding what kind of contribution that they make. Traditional performance is also on enhancing the revenue generating capacity. So, you know, of course, there's a lot of distribution of assets in terms of securitization vehicles and participating in those. But that being said, you know, the downside challenge is that sometimes securitization in itself can reduce the returns and reduce the contribution or the distribution of dividends and so forth. And then, of course, if the approach is really assets at any cost, we are now looking at growth in poor quality loans, and it can come back to haunt you in terms of going bad, in terms of your expected credit losses going up. And that essentially implies that your insurance premium is also going up, and which would then mean that, you know, your entire portfolio is going to have to subsidize the payment of the premium to protect you or protect the institution against bad loans. So that's the sort of sets in motion and a cycle which would make it very hard to get out. And, you know, the next thing is that you would want more capital so that you can clean up the book and so forth. If you look at the right side of the equation, where we're talking about how risk-adjusted performance can create the level of transparency in terms of the projected and actual returns, but it also helps you keep the balance sheet clean. It also helps you actually focus on assets which are high quality, which are adding value. And of course, you know, you are driving an organization which is more focused on developing a risk reward, or any sort of additional risk implies that you have an incremental reward associated with that. So that's the kind of change in an organizational or institutional behavior that something like this or a quantitative metric like this can bring about. Perfect. So this brings us to the last slide, and, you know, we would have then 5 to 8 minutes to go over the questions and be able to provide the answer. So essentially, the objective of today's discussion was really talk about risk analytics and how it can increase the fluidity between risk, finance, and businesses. And by risk analytics, is what we simply mean looking at the data that provides you with the kind of metric that you want to be able to share with your within your community, and it allows a deeper understanding of the relationships that exist between different silos currently, and removes those silos and allows the free flow of ideas and free flow of data, and then develop what we would call a risk acceptance criteria. In other words, any new asset that you bring in or bring on the books has to be able to meet that minimal risk acceptance. A lot of the credit unions need to start looking into integrating the risk acceptance criteria in their credit policies. So that's one key takeaway. The other targeted benefits that we can think of are essentially better efficiency and better return. When we are looking at activity-based costing, we're also looking at the portfolio, which is currently being managed by the RMs. And we're also looking at the number of loans which are currently being handled by certain portfolio managers and the products that are being originated. And it also allows you to focus on those white spaces so that you can create different permutations from your existing product base. So for example, if you were to actually think of developing different features associated with the mortgages, by having that sort of data in place, you're able to actually conduct that. And finally, this is a tactical lever. It is clearly very easy to make it part of your strategy, and it adds value to the business. And of course, at an aggregate level, holistic benefits, net benefit to the organization, and moving the corporate strategy forward. So that brings us to the end. Andy, your closing comments, and then we can take the questions.
Thank you, Sohail. I think you've covered this last slide is really important. And, one of the things that I've noticed over the last number of years working with some of my credit union clients and sitting on some boards is the fact that these kinds of concepts are finding themselves into the discussion at the management level. But I would also urge credit union management to bring these kinds of concepts to the director and the board level and the committee levels, because these are the people that are going to be able to provide you with the support and the resources that you're going to need to be able to manage these things better. And I think from a governance perspective, understanding these concepts is going to become more and more important from a board perspective to provide that support and help to management to manage the risks better. Thank you.
Oh, thank you very much. Any questions, Mimi, Alex? Not, I have a couple questions here from people that had to leave, but they sent a couple questions. I'm going to go ahead with these. So first question was, how can credit unions develop risk appetite framework?
So maybe I'll start with that, and Sohail, you can jump in.
Sure.
The risk appetite framework is really a reflection of the risk biases of the people at the table, both board and management. Every credit union should really sit down and think about the relationship between the risk appetite and the risk capacity and the risk tolerances. Those three concepts have to be able to link together nicely. And that conversation can be had at the board level and at management levels, and presumably together. So I think it's important that the organization articulate a very, very clear risk appetite, because that's going to drive a significant significant portion of the discussion around what strategies are put in place and what kind of risk profiles the credit unions are looking for in its own membership. So just some general comments, and over to you, Sohail.
Perfect. Yeah, thank you so much, Andy. I think risk appetite is increasingly becoming an important statement, organizational statement to have. From my perspective, when I look at risk appetite and developing a risk appetite framework, I look at the accountability that exists within the organization to different constituencies. So who are the stakeholders from an internal and external perspective, and what is their demand for information? We've got employees or FTEs who are key stakeholders from an internal perspective. We've got the board members who are internal stakeholders. And then if you were to look at externally, you have the regulators, you also have the members who are external stakeholders. Now, if you were to actually understand the demands of these four constituencies and what is it that they're looking for, so are members interested more in safeguarding the capital, preserving the capital, or they're more interested in actually improving the returns? And these are the questions that need to be addressed and analyzed, by communicating with the community that credit union engages in. Similarly, from a regulatory perspective, what is the regulator's focus? Is regulator more focused on preserving the organization or looking at increasing the profitability of the organization? Clearly, the regulator's focus is on having the organization preserved and saved, not just in good times, but also in times of distress. So then we're looking at defining the key metrics that the regulators would want to get from credit unions. So that should become part of a risk appetite. Similarly, from members' perspective, we talked about opportunity cost, which is available to members. Now, it is a clear concern that, in a declining or in a depleting membership environment, what sort of credit unions offering is existing for the members, and what would keep them on board? And clearly having more return, providing some kind of dividend or some kind of payback would be a great idea. And for that, and to sort of bring about that change, we need to start looking at these types of frameworks that we discussed from employees' perspective, from unions' perspective that operate within credit unions. What are their key concerns? Now, those concerns can also become part of the risk appetite. And similarly, what are the concerns of the board? All these demands can then be sort of synthesized and looked at from a priority perspective and then made part of the risk appetite. And the final piece of the puzzle is really looking at the risk profile, as Andy mentioned, that, and looking at some of the constraints. Now, these constraints are, of course, the capital constraint. These constraints are also relating to that, a credit union would not be acquiring assets, all assets at any cost, but rather, assets which are of high quality and which actually provide the return that is needed. So that fits into the risk profile framework. And clearly you have these four different constituencies with four different requirements, and they should all be sort of created in a balanced way and set out in a risk appetite framework.
Thank you, Sohail, Andy. We only have a couple minutes left, but the second question was, what management dashboard need to be created?
Exactly. Andy, would you like to go ahead or sort of?
No, go ahead.
Okay. Yeah. So yes. So I think this question is partly answered in developing the risk appetite, understanding the risk appetite, and of course the key metrics and performance relative to the limits which are set out in risk appetite should be part of the management dashboard. But I think that should not stop there. For example, we talked about the silos and functional capabilities. We have risk, we have finance, we have treasury, we have strategy under the CEO, we have compliance, we have money laundering, and so forth. So these are all important requirements that need to be borne in mind and kept in mind before of course, a credit union can operate at a high efficiency and a high speed and be able to deliver it on its promises. So those are important aspects and important inputs to the management dashboard. And of course, there are qualitative as well as quantitative aspects to it. And not to forget, liquidity, operating in different economic environments, such as what we are in currently, needs to be addressed. And those stressed environments demand a different type of framework, and of course, this is what we would call a recovery plan or a management action plan under extreme stress situations, which should all be part of the dashboard, and which should also clearly lay out the sequencing of different actions that the management would be undertaking during different periods of time.
I think to just add to your comments, Sohail, I think this period of time is probably the most important time to have a very, very comprehensive and well thought out dashboard for both management and the board. Only because these stress times are going to give you early indicators on that dashboard of whether you're headed in the wrong direction, and what corrective action needs to be taken as soon as possible to avert a problem down the road. And so on the boards I sit on, that's been a key component of the reporting to the board and to management, to senior management, over the last number of months. What are the key metrics? What's the risk appetite and risk tolerances, and where are we headed? Are we headed in the right direction, or are things getting into trouble? And what are we going to do about it? So I think you're dead bang on there. Thanks.
Thank you very much, Andy, Sohail, for your valuable insights. This concludes our webinar. We'd like special thanks for the executive that took the time to join us today. I hope you found this presentation useful.